Welcome to Mark Arnold's Finance. Today is a very special video because I'm looking at my portfolio and I'm taking my individual holdings and I'm ranking them from worst to best based on two important measurements. I am choosing these two measurements because of the possibility of going into a recession, and I think these are the two most important, and that's going to be cash flow. Now, I'm specifically going to look at the cash flow from operations trailing 12 months and over the last 5 years to see if they've had growth or declines. And this gets us to look at, are the sales increasing or decreasing, or are the expenses going up or down? And this really is a reward to the investors. When you're investing in a company, you're really investing in their cash flows. And if there's good cash flows, that usually signals higher earnings in the future. I also want to look at debt, specifically their debt to assets, because at the end of the day, if a company is highly leveraged, has a lot of debt, they're at risk for going under because it depends if they can repay that with the cash that they hold. And so the debt to me is just a big hinder on a lot of companies, and that's what I want to focus on. So before we get started, let's look at my portfolio performance. We'll see here I am down 2.55%. So we've seen some improvement. Last time I was down 4.2. So I'm only about $1,200 of in the red. That's unrealized loss. Take a look at all these holdings. We're going to be ranking these, and be sure to ask me any questions should you have any. And if you appreciate someone who shares their portfolio, this is real money, these are real holdings, be sure to subscribe to my channel. I think this is a channel where I share diverse content, and it's just going to help us all grow and learn together. So let's get started, and I have 17 holdings that we're going to cover. And so we're going to start with the worst, and then we'll move up to the best. So the worst that we will start with is number 17, and that is Tattooed Chef. You'll see here, over the trailing 12 months, their operating cash flow has gone down 103%. Now, their cash flow the last 5 years hasn't been updated because this is as of the year end of their report. So once they report the year end of 2022, this will update, but I guarantee you this will shrink massively. And then their total debt to assets. Right now, it is low at a 9.83, but the company has already voiced that they're going to be having to take out some pretty hefty debt in order to keep the company surviving. So for these reasons, with the crash in their cash flows, with the expected rise dramatically in their debt, I think this is my weakest link, and this company is the most at risk of going out of business. So Tattooed Chef is number 17. At number 16, we have 3M. Now, 3M is a company that has been struggling for a while, very slow growth, and they have a lot of litigation issues. So 3M will see over the trailing 12 months, their operating cash flow has dropped 32.67%. Their total debt to assets is at 37.62, and their last 5 years of their cash flow has only grown an abysmal 3.73%. So none of these numbers are attractive for investors. And I think the big risk is the litigation expenses in the future. We just don't know what that's going to look like. And with already how their cash is shrinking and their debt is higher than what I would say this, the debt I prefer is about 25% or below. And so I think 3M is getting in a risky area where things can start happening, right? Cutting their dividend, having to take out a lot more loans to pay off any type of litigation. But regardless, I just don't think this is strong, and why it comes in as number 16. Number 15 is Warner Bros. Discovery. Now, this was a spinoff of AT&T, and its cash flow over the last trailing 12 months is down 19.12%. And over the last 5 years, it's grown 11.43%, but that's nothing to be proud of. And their debt is high at 40.2%. Now, with Warner Bros., I feel they're in the streaming business, which is a hard one to become profitable. Only Netflix has proven to be profitable. So I think they have a long road ahead, and they're definitely at risk of having some issues in the future. So they come in at number 15. Number 14 pairs up with this last one, and that's AT&T. Looks like their trailing 12 months of their cash flow is down 29.29%, and the last 5 years, they've only grown their cash flow 2%. That's barely anything. And then their debt is high at 37.93. Though it has slowly, finally been going down, it's at a very slow rate. So to me, AT&T is just such a slow growing company in all areas, and their cash flow I don't think will change. I think it'll continue at a very small, slow growth, which means their future earnings will struggle. So that's why I put this in the lower half of the ratings. Now we're moving to number 13, Starwood Property Trust. Now this company is involved in a lot of commercial and real estate loans, and we'll see their operating cash flow has grown 154.67%, but I will note that their cash flow was negative and they turned it to the positive, but it's still low cash flow overall, a low total cash that they hold. And we'll see their last 5 years kind of reflects that. It's only grown 4.16%, and their debt's astronomical at 91%. So though I think this company has some sturdiness, it's kind of a boring company. It's like an AT&T. It's just going to be a slow grower. I bought into this for the high dividend yield at over 9% right now. A long time ago when I first started investing, and I really have no reason to stay in this company. So I think I might be exiting this at some point. So for now, that's why I rank it towards the bottom. Now, number 12 is going to be a surprise. Being at the bottom half is Home Depot. Now for Home Depot, their operating cash flow over the trailing 12 months is down 25.14%. And over the last 5 years, it's grown decent at 14.47%. But that's nothing to be proud of either. And their debt is what really gets me. They're at 63.49%. Now, I have no doubt that Home Depot will be around as long as I'm alive. But with numbers like this, their future growth is going to be a challenge. And so that's why I rank it where it is. At number 11, we have Coca-Cola. Now, over the trailing 12 months, their cash flow has gone down 12.6%. Over the last 5 years, it's only grown 6.3%, and they have a lot of debt at 44.76%. For me, Coca-Cola is just that sturdy, low-risk stock that it's a consumer staple. So it's a product that people will buy regularly, but this is a company I don't think will provide high growth. It's not going to outperform the S&P 500s, shall we say. Which is why I rank it lower, because I think this company's just going to struggle with providing decent growth in the future. Next up is number 10, and that's Realty Income Corporation. Now their cash flows have improved, and they've actually grown 99.28% over the trailing 12 months. But if you take that out to 5 years, it's only 2.64%, which is not good. And also their debt's decent at 36.86%. Now, I will say with they're making a lot of purchases of properties, and that's one reason why that debt can be high. And it just depends what the debt is high and used for. If it's going to return, make a good return on their investment, which I think Realty Income will. So that's why it's kind of in the middle range. But I don't think this one will outperform the S&P in the future, which is why I rank it where it is. But I do like that their cash flows are improving. Coming in at number 9 is Abbvie. Now, Abbvie, over the last trailing 12 months, their cash flow has gone down a little over 1% at 1.06. Now, their 5-year cash flow growth is good at 22.95%, but where I have an issue with Abbvie is that 51.13% debt to asset percentage, and that's just, to me, not going to help this company be able to deploy cash in a way that others could. A lot of pharmaceutical companies have a lot of debt, and with Abbvie and their Humira patent expiring soon, it's just putting me a little on edge, which is why I'm ranking it as the number 9 spot. Now in number 8, this one is also a surprise to me. I thought it would be higher. I wish it were higher, but I have to go off of the data, and that's Amazon. Amazon's cash flow over the trailing 12 months is down a massive 27.48%. Now over the past 5 years, though, they kind of do some good here, and they grew their cash flows 44.48%, which is awesome. Now, the debt for this company is a little too high for my liking at 36.16. So I just feel Amazon, they definitely have a future, but they just have to get it together. They have to start providing investors with some positive earnings, some good cash flow, and just focus on lowering that debt, because they like to invest in a lot of things, and most of it is good investments, and they make good returns, but some of them are just duds. So Amazon, for me, makes it to that number 8 spot for that reason. Now in number 7 is going to be Johnson & Johnson. Now their cash flows over the trailing 12 months have gone down 10.37%, And over the last 5 years, it's only grown 6.85%, but I really like their debt levels at 18.44%. This is a company that I feel is just very sturdy and that it's low risk. It's going to be here the rest of my life, and they're spinning off part of their business. So I really think this company in the future will grow more towards a growth stock, shall we say, with their numbers. But we're going to have to wait and see how that happens. They're going to focus on medical devices and pharmaceuticals and spin off their consumer products. So this is a stock I'm excited about and why I ranked it at where it is at number 7. Number 6 is Cisco. Now, their cash flows over the last trailing 12 months have been good. They've grown 15.61%, but over the past 5 years, it's been pretty low at 3.44%, and their debt is low, which is good, at 11.63%. So why it comes in at the number 6 spot, even though these numbers are good but not exceptional, is because Cisco is transitioning into subscription-based services. And if they can do that successfully, this company will become a growth stock, I believe, and it could outperform the S&P 500. So that's why I put it in at number 6. Now, number 5 is Bank of America. Now, their cash flows over the trailing 12 months have grown an impressive 28.01%. And over the past 5 years, it's low, but it's at a 10.95%. And their debt is low at a 16.44. For me, Bank of America is one that will provide growth. I don't think it'll outperform the S&P 500, but I think the financial sector in general is just undervalued. And I think Bank of America will be able to provide some good, sturdy returns and grow their cash flows and keep their debt low in the future, which is why I put it at number 5. Now, number 4 might be a surprise, and that's Ally Financial. Yes, this company has risk because it has a lot of money tied up with, or a lot of their business is tied up with auto loans. But look here, their cash flows over the trailing 12 months have grown an impressive 64.58%. Now, over the past 5 years, it's very slow at 5.10%, which is not that great, but their debt, I love that they have low debt to assets of 11.62%. So this company has room to deal with some negatives in the economy, and it should survive no problem. Plus, I think Ally is so undervalued that it's more of an upside potential than a downside type of stock, and I really like this product. So maybe some of this is biased, but I am looking at these numbers, and that's what I really factored in, and think Ally deserves the number 4 spot for what they're producing. The next stock, number 3, we're in the top 3 now, is Meta. Now, this one you might disagree with, but hear me out first. Their cash flow over the trailing 12 months is down 9.13%, which is actually not too bad considering the pullback in advertisement revenue. And if you pull that out to the last 5 years, it's grown an impressive 30.39%. And what I love most is their debt is low at 10.65%. Mark Zuckerberg just came out and said that they're focusing on cutting costs with the metaverse. They're reducing employee count. So all this should really provide some really strong earnings within the next couple years, which will boost this stock up, boost that cash flow, and I hope they keep that debt low as well. So I really do think that this company financially is still very strong despite all the turbulence and all the hate that it's gotten. Now, in the number 2 spot, we have Vici. This company has grown their cash flows over the trailing 12 months, cash flows from operations, 138.13%. This is the largest growth out of all my holdings. Now, their debt's at 40%, but this company is acquiring quality properties that are proving to be good returns, provide good returns on those investments. And Vici is an experiential REIT, which I feel having a lot of their properties on the Vegas Strip, this is an area that's just going to keep growing, and they also are expanding nationwide, and there's even talk of global expansion at some point. So I just think this company has high potential to outperform the S&P 500 for a long time to come, and that's why this deserves the number 2 spot. So that leaves us with the number 1 stock, which you might guess by now, but that is Microsoft. Now, you'll notice these aren't the best numbers out of all these companies, but let me just go over the numbers and then I'll explain. Over the trailing 12 months, their cash flow has gone down 5.47%. Now, in the tech industry, keep in mind Amazon's down over 27%, Meta 9%. Microsoft is holding strong. especially because they're having to deal with all the global kind of exchange rates with their money. Over the last 5 years, their cash has grown 24.67%. So, I think this company's holding up extremely well for the global turbulence that is going on, and it could have been a lot worse. What I like is they still have relatively low debt at 22.27%. So these numbers in whole are strong. Yes, their cash flow is down, but I think that will turn around pretty quickly because Microsoft is such a high quality company with quality revenue, right? They have mainly subscription based revenue with corporations, with companies that use their Microsoft products. And what that does is create, I think, one of the sturdiest, dependable streams of income out of any company. And with subscriptions, you can raise those every year pretty easily, and companies will keep paying because your product is so sticky. So I just think Microsoft deserves to be in the top one spot because of the quality of this company. And really, I just think this is like a bond. You can almost guarantee that this company will grow. Now, I'm not guaranteeing that, but I'm saying it's close to a guarantee because anything could go wrong with any company, even Microsoft. But I really think it's such a strong company that this company has high potential of outperforming the S&P 500 over the next couple years. So let's see if this reigns true. So again, I factored in a little bit of everything, but focused on the cash and the debt. So if I focused on also, let's say, the return on equity, the PE ratio, the dividend information, the gross margins, et cetera, this, I think there'd be some change in the rankings, but I think it would be pretty similar because I think that cash flow and debt really reflect on the rest of the numbers. So let me know, here they are, all my 17 stocks ranked from worst to best based mainly on cash flow and debt. Let me know if you agree with my rankings. I'm okay if you disagree because I'd love to hear why, because we're teaching each other things here and you might bring up some points that I'm not considering. So I hope you like this content. I hope this brings to light and maybe something you can do with your own portfolio because I think right now in these times, like I said, of possible recessions, these economic hard times, the cash flow and debt is what matters the most. And that's just my opinion. If there's any other metrics you think matter more than these, let me know because I can always do another video but change what metrics I'm weighing the heaviest, which in this video is the cash and debt. So thank you guys for joining me today. Be sure to subscribe if you appreciate this content. It took a lot to put this video together. I had to do a lot of calculations on my own because some of the platforms I use, I couldn't get these calculations. So I had to go into the financials myself and get them, calculate them. And so thank you so much for joining. We'll see you next time on Mark Arnold's Finance and have a great day.